Close. Hey guys, it's 2 o'clock and it is Talk to Me Tuesday time. You see my guy here. I got Ron Rice, Ron the mortgage guy here with me, and I'm super excited to go live with you guys. We have done like 6 different clips trying to get this thing to go sideways, and it's just like really not agreeing with me. I don't really know. I'm kind of disappointed in Facebook right now because I just think with all the technology, I should be able to turn my phone sideways and still, rock this thing out. But thank you so much for joining us and tuning in. I'm super excited. So I'm going to play with the cameras a little bit. And so in a second, you're going to see my guy, Ron. Let me just give you a little bit of information about him just because I know him really well and I call him my guy, but you guys don't know him yet, so he's not your guy yet. So really quickly, his name is Ron David Rice, and I'll probably tag him when this is over so that you can send him a friend request and all of that. He likes people. So yes, you can do that. He is actually a native of Huntsville, Alabama, and I want to say he graduated from Johnson.
I did.
J.O. Johnson. Yeah, so he screams that real good.
Jaguars.
See, you hear that. He is a real big family man. I love his wife, Lovey. Hey, boo, if you're watching us, I'm sure you'll tune in, if not now, in a little bit, because I know you got lunch and all of that wonderful stuff. And he is a graduate of Oakwood University, which is a HBCU.
The oldest. One of the oldest.
One of the oldest HBCUs. So, there's that. He still likes the hill, though, too. He's kind of like a
grew up on the hill,
A&M Bulldog kind of guy. Anywho, really important. He entered into the mortgage industry in 2003. I had the pleasure of meeting him actually originally when he was a mortgage broker, and we did a couple of deals together, and then he wanted to learn more about what I did, so he actually came and spent 2 years over here with Credit One USA, and we worked together, and he used to be my work husband. Now he's we're geographically separated, but he's still my work husband.
Forever.
But look, we have clear boundaries. You don't even got to worry about it. We got clear boundaries, and his wife is real accepting of it. We got a 6 p.m. cutoff, Monday through Friday only, that kind of stuff. Anywho, he's very knowledgeable about the mortgage industry. In fact, he is my go-to guy when I'm talking to people and they want to get a house. I'm like, hey, Ron, what do you think about this? Hey, Ron, what do you think about that? He does FHA loans, VA loans, subprime loans, conventional, all of that wonderful stuff. And I'm going to let him tell you all of the states he's licensed in. But I think it's at least
close to 15 now.
15. I was going to say 13 and I was going to be off. So yeah, he does a lot of stuff for me. And so without further ado, this is my guy, Mr. Ron Rice.
Hey, Facebook. How y'all doing today? Good afternoon. We got a little bit of snow here in Huntsville, so I'm telling you, if you're watching or if you're listening and you're driving, please be careful. Do not drive distracted. More importantly, man, I'm excited about being here, coming back to Credit One. This is kind of, I consider my roots. Great relationship with this organization. They've helped lots of my customers become homeowners. So I'm really excited to be here, but more importantly, just to impart a little bit of knowledge to you guys about home ownership. More importantly, about getting prepared, having a plan, getting your credit together, saving money. These are all things that we'll touch on today. But more importantly, I'd like to just encourage you to, in the comments, make sure you ask questions if you have questions. We'll be reading the comments and I'll try to address them. I want to get a couple of house cleaning things out of the way. I work for Hometown Lenders here in Huntsville, Alabama. Our NMLS is 65084. I'm a licensed mortgage loan advisor. My NMLS ID is 309793. Been licensed with them now close to about 2 years. Worked for First Family and worked for several other companies. I have a plethora of experience in this. I've seen lots of scenarios, but I always see something new in this business. So please feel free to ask questions in the comments if you have questions about this. The first thing I want to talk about, if I can.
Hey, our guys are talking to us.
Hey.
Hi.
Hey, everybody.
Hey, are you licensed in Georgia?
We actually are going to get back into Georgia. We haven't made it back to Georgia yet, but I do have connections. So if you want to inbox me, Ronald David Rice That's my name on Facebook. If you want to shoot me an inbox, I'll be happy to try to connect you with somebody in my network. As you know, in this industry, it's kind of like the mafia. You know people that are made in other states, so you're able to send business, and we connect that way. So I'll be happy to help you find someone. And in the future, I might be that guy. But one of the things that I want to kind of get into at first, if I can, is to tell you, you can't own a home. This market is great right now, not just in Huntsville, but in the United States. We don't like Trump, but I got to tell you, he's got this economy moving. And I can tell you, man, this is the time.
Say we don't like Trump.
I can't say that.
You can say you don't like Trump.
Okay. Okay. Go with that.
We're working on it.
We're working on it. It's okay. But yeah, money is swirling right now. So it's an opportunity for anybody to try to get qualified. And what often happens is there are lots of people out there that are renting that can buy. And then there are people who are trying to buy who can't. We'll talk about both of those and how we can benefit from that. But one of the first things I want to talk to you about is the preparation for home ownership. A lot of people feel like you got to save $1 million to be able to put just huge down payment. And I want to tell you that there are lots of first-time home buyer programs out there. Madison County has a great program with grant assistance that they will help you get down payment money. And it's not a set amount. It's an amount to help you meet the shortfall that closing costs and different things you can encompass when purchasing a home. So I want to tell you that the preparation to get a home is not one of those all-encompassing things where you need to say, I'm going to get one in 2022. Let me tell you, the market may have changed in 2022 along with the rates. If you can buy today, I encourage you to do so. Next thing I want to talk about is why we're here, and the place that we are is credit. Credit is a very important thing. Your credit, as you probably know, determines your interest rate. Interest rate determines your payment. If you want a low payment, you got to qualify. Qualifying means you need to get the best possible credit you can have. Now, there are going to be extenuating circumstances where your credit is not going to, you're going to need to go ahead and take advantage of purchasing a home, but your credit may not be where it needs to be. But what I can tell you is there are lots of programs out there. People who are self-employed, all kinds of programs out there, bank statement loans. Pretty much a lot of the subprime programs that were out back in the 2000s when the crash happened, those programs are back. So I can say to you without quoting interest, because I can't do that on this feed right now. That would be against state regulations. I'd have to give you an APR, like the car commercial stuff. So we won't get into that. So please, nobody ask for an interest rate on here. We can get that off bankrate.com or something online.
So you said if they want they want to know what the interest rate is right now, they can go to bankrate.com.
They could go to, and just so you know, I'm not representing bankrate.com. Or I would recommend you call a mortgage professional and get pre-qualified. And that's something we'll talk about in one of the next bullet points. The next thing I want to talk about is cash. Purchasing a home will require you to have some cash. You may be able to get a down payment assistance program. You may have the credit to get a good low payment, but you are going to require some cash. You're going to have to pay for things like an appraisal. You may have to have a home inspection. You may have to have a termite bond. There are going to be programs and different things that you'll have to invest your money. And in most cases, FHA, VA, and some of the conventional are going to want to see some type of cash reserves available. Cash reserves just means you have the capability of saving money, but more importantly, you can make a payment should there be extenuating circumstances. Let me tell you, the bank doesn't want to hear that your car broke down and you missed a couple of shifts from work because the baby was sick. That's not going to fly with the mortgage. That's not going to fly with your mortgage lien holder. Qualifications. Let's talk about qualifying. You want to qualify. Yes. Qualifying. Yes. You want to be on your job for 2 years. Mm-hmm. Or you want to be employed for 2 years. Let me explain the difference. You can be working out at Target for 2 consecutive years. That's 2 years of employment. Or you could have been working for JCPenney and you moved to Target. But you were at JCPenney for a year and there was no lapse in your employment and you went to work for Target. And you've been working there for a year. That's 2 years of employment.
Can I jump in real quick?
Sure, go right ahead.
Okay, so I know that you always tell me about this, and I like to make it really, really simple when we're talking about mortgages because you know how important that is. When you say being employed for 2 years, you really mean 2 years in the same industry, right?
Yes.
Okay.
And I'm glad you brought that up.
Make sure you said that.
She stole a little bit of my thunder. Yes. But you don't want to be a crossing guard and then you're a surgeon next year, because what happens is the underwriters. And we'll talk a little bit. Yeah, I know, surgeon. Yeah, that was pretty drastic. Okay. The underwriter's job is to determine and or assess risk. So what they're doing is they're in the best interest of the bank, the people lending you the money. So if there's something on your credit or in your profile that makes them feel a little funny about it, they're going to ask for things that we call conditions. That means they're going to ask for you to prove that you've been on this job or write an explanation on why you left this industry to join this industry. It doesn't mean you couldn't be something else and be something else in a 2-year period. But we want to make sure that those employments joist together and that there's a good explanation for it. You were in college and you were working at Target. Once you got your engineering degree, you left your clerk job and became an engineer on the Arsenal. That can easily be explained, and that would be a good segue. And I think that the underwriter would agree that you can have more stable employment working out on the Arsenal as an engineer. I'm not saying Target isn't, stable, so don't take that the wrong way. But your qualifications, 2 years of employment. You want to have good income. You don't want to have a lot of debt. That means you don't want to owe everybody in your check to check. Oftentimes people want to buy, but they haven't assessed their current financial situation. And as a result, a house payment may be more than what they can handle at the time. Or the house they fall in love with, they can't afford. Oftentimes that happens with my younger couples. They really love that house, but it's $250,000 and their income can only stand about $150,000. So you want to be able to be prepared for that. And what I'd like to encourage your young couples that are watching this, don't try to get your dream house the first house. You're going to grow, your family's going to grow, things are going to change. So when that happens, you're going to move to another house. In my childhood, we lived in 3 houses. That was from grade school to when I left for the Air Force. We were in 3 houses. And then my mom built her dream home after we left on the lake. Mom, should have built that when I was living there. But anyway.
That's just because you like fishing.
And you know it. That was part of my bio. She'd have mentioned that. I'm a big fisherman. But anyway.
Yeah.
Let's go to the next thing. Job time, which we covered that. Pay your bills on time. That's the thing that shows your stability. And I know Millie has preached that on this podcast, this Facebook Live. But you want to pay your bills.
I have to go before I do, which can explain what a person can do while in bankruptcy to get ready for a home. Let's see. How to get home ready for later. Thank you so much.
Great. Nancy, please shoot me an inbox. I can actually address that, though. I just didn't want to say that out loud. And I guess everybody can see this.
Well, here's the thing. It's a couple of things that you can do, and it varies, 1, by the type of bankruptcy you're in, 2, by how long you've been into it, how close you are to discharge, and some other comments with that. So I think if you shoot either me or Ron a message, we can give you a lot more details because your case is a little more specific, and I don't want to give you general information that doesn't actually apply to you.
And just for the audience there, from a bankruptcy standpoint, there are programs out there for you that you can get in one day out of bankruptcy. But what I can tell you is because you were in bankruptcy, you represent a higher risk. So you want to be sure that you understand that if you want to take on one of these programs, you're probably looking at a higher payment type situation. Mm-hmm. So that's something to consider when you come out of bankruptcy. That doesn't mean, because there are people that come out of bankruptcy with very good credit scores, but because you were in bankruptcy, you still represent a risk because you just told all your other creditors you couldn't pay them. So the new creditor is saying, hey, are you sure you can pay me? So that's something to consider. I want to talk a little bit. I was talking about paying your bills. Paying your bills on time is essential. Most of all because they have new programs out where you can get alternate trade lines that are representative. You paying your utility bills, cell phone bills, stuff like that. But most of the time, people who pay those bills, those are necessary bills because you got to have communication, you got to have power. But that's a representation of how you manage your money. So your credit often tells the story about how you manage your finances. But you want to pay your bills because if you've been late on a credit card 3 months ago, it probably tanked your score and you were qualified 3 months ago and now you're not qualified. So make sure you pay your bills on time. You want to try to keep your bills below 30%, as Millie often talks about, but you probably want to keep them at 0% if you
I was going to say, don't you come in here telling my people bad information. 0 to 6% on revolving credit. When he's talking about 30%, he's talking about something else. He ain't talking to y'all. He's talking about to other people who want to pay more for their mortgages. Not my people. My people don't like paying more for their mortgages, so we're not going to do that same thing. But anywho, we're still listening.
We're still listening. Okay, great.
This is the 750 Score Challenge group, so we're on a higher level.
Okay. I like the 750. Those loans close very quickly.
Look, oh, I'm glad you said that. I know you got a whole bullet point list, y'all, and I promise you we're going to get to a lot of the stuff on his bullet points eventually, but I know y'all like questions, so we're going to jump into some of my questions really quickly. These are things that, of course, customers ask me, and if y'all have questions and y'all want to jump in here and shoot them, I know I have my own separate watch group, so I will respond to y'all over in my group too. So if y'all see me answering questions that y'all can't see, it's because I got a whole second group tuning in.
And I want to tell you, I get a glare from the screen, so I'm looking. It looks like I'm squinting. It's just because I'm trying to see if you...
That's just people watching.
Okay.
We answered that.
Okay, we
I'm
answered that question.
trying to watch them both. Just,
Perfect.
give me a second. But what I was saying is, as far as that really quickly, what is the difference? I've heard, and this is something I want you to clarify because I talk to people about it individually, but as a group, I want you to explain why it's better to have a higher credit score because, mortgage brokers tell my people, oh, I can get you in with a 580, I can get you in with a 600, 610. What is the benefit of having that 750 when it comes to your mortgage?
Well, what I can say to you, the 750 people out there, is that your loan is going to matriculate through the system faster because higher credit scores typically represent a person who is a stable borrower, a person who's paid their bills, who has a low debt model, and who oftentimes has been on their job for a good period of time. The only exception to that might be somebody who's fresh out of college and has a 750 score because they had a credit card for the last 18 months and that's all they've ever paid. Student loans and one credit card. But that often represents the stability of a borrower. And a person who's stable, they've got great job time, they've been on their job for 5 years, they paid off a car, they only have a couple of credit cards, and all of them are below 6%.
There we go.
That person, in all likelihood, represents a borrower that will most likely make their mortgage payment on time. When your credit score is above 750, it's actually tiered. The higher tier people are going to qualify for interest rates here. The next tier are going to qualify for interest rates here. And then it goes, and as it gets lower, the interest rates get higher. And the payment, of course, gets higher because a higher interest rate represents a higher payment. So you want to get your scores up here because you want to get the lower payment, higher credit score, lower payment, lower credit score, higher payment. Now, I can tell you FHA has some good programs out there, and FHA oftentimes will have lower rates than conventional. No offense against the conventional people out there because I love conventional too. But FHA is going to probably be the easiest loans that you can get, and you're going to have a lower interest rate. But you also, conversely, are going to have what's called mortgage insurance. Now, you're going to have mortgage insurance on a conventional, but the mortgage insurance on FHA is going to be mandatory. And that's something we can talk about on the sidebar. I don't want to get too down the road into the intricacies of the mortgage payment and mortgage insurance and stuff like that.
It just means that you pay more, though. Right?
It means you pay more. That's exactly what it means. Now, another thing that we want to talk about here in getting yourself prepared and qualified is, more importantly, having someone that you can get pre-qualified with. I'm a mortgage professional. I may not be your choice for mortgage loan originator. However, I'm a guy who is a resource for Credit One USA, but more importantly, can be a resource for you. It's important that you talk to a mortgage professional and see about getting pre-qualified. The no might be what catapults you into the next stage of getting prepared. But if you just go out there and say, I know my credit's sorry, I can't get a house, and then you go sign a lease for 12 months, you may have been pleasantly surprised to find out you actually could qualify and that there are down payment programs that could assist you and get you into your first home. And you'd be paying and building equity in yourself instead of paying somebody else's mortgage. And that's the thing we want to encourage, is to build equity in self by, getting qualified. You want to talk to a mortgage professional, somebody that can get you qualified. Millie's going to put my link in the comments. So if you want to get pre-qualified, you actually can do that. This isn't a ploy for me to try to get people to try to get mortgages. Getting pre-qualified is going to be a thing that will help you understand exactly where you are. I do consultations all the time. So it's not always about me getting applications to get deals. I help a lot of people. I believe that I was blessed with knowledge, and all of the knowledge I don't get paid for. A lot of it I give advice and I give people encouraging things on, or give them pointers on what to do to get prepared. There are people that have been qualified, but qualified for that lower tier, and they've had a really ridiculous payment and stuff. I've encouraged those people to, hey man, why don't you wait about 6 months, pay this card down and this down, see about getting your score up a little higher, and then let's put this in the system again and see what you qualify for. I had a customer that we closed. That person saved about $150, $200 by just waiting about 6 months. Had
$200 total or a month?
No, $200 a month. So that's $2,400 a year. So in 10 years,
that's Christmas.
There you have it. So that person, had they not been the person, now if they had been in an extenuating circumstance, i.e. they were living in a bad neighborhood, their car was getting broken into every day, or a woman leaving an abusive relationship or something like that, I would have went ahead and signed the mortgage and let's move forward. But in that particular situation, it behooved them to wait a little while, get their scores up, get themselves in the position where they can be ready to get the lower payment and the best payment. Because please believe, it's kind of like buying an automobile or any other thing that you get with a payment. You want to get the best possible payment you can. You know, when you go looking for a car, you go, I don't want to pay no more than $300 a month. And then you walk out of there with a $450 payment. But that's because, you know, either your credit wasn't where it needed to be, or they just sold you, they sold you on the S class instead of the C class.
Can I go back to something really quickly that you said? Because you kind of glossed over it and it was really, really important to me. Is you said get pre-qualified?
Pre-qualified.
Tell me what pre-qualified is and how that process should work as opposed to how it does work.
Okay. Pre-qualified is going to be a person follows my link and they do an actual credit application. They're going to provide with me the information, their job time, their name, address, social. It's going to be a hard credit inquiry. It's going to be an application for credit because you are actually applying for a mortgage. Me being able to look at your job time, your credit score, the assets that you have in the bank and all that will paint the picture as to what you can qualify for at this time. That process is very quick. If you fill out a link, I can get it, have your credit up in about 5 to 10 minutes. However, how detailed you are on that application will tell me what I can actually get you qualified for. That application has a place for your assets, things that you own, your retirement, any cash reserves, things that you have. More importantly, how long you've been on your job, how long you lived at your current residence. The other thing I want to talk about, because we were talking about qualifying a little earlier, is people who move around a lot. You don't represent stability when you move around a lot. As a result, that's something that may or may not have to be explained. I pull credit bureaus where a person has this many addresses. You lived here, you lived here, you lived here. And you're not going to tell me. You just can't convince me that you paid every one of those leases. Unless you're military and you move every year and a half, that's in all likelihood, you left those situations in an adverse condition. And as a result, your credit will reflect that. That's no reflection on people that may, in a small percentage, have to move all the time. But what I'm saying to you is stability is represented in a number of ways. I've looked at enough credit, and so has Millie. We can tell you everything about yourself just by looking at your credit. Your credit tells your story. It's your resume for your life. That's the truth.
Okay, really quickly, I'm going to jump in here because, again, he goes from the mortgage side, and I'm going to take you back to my 750 group. One of the things I always tell y'all is before you put in your application and apply for anything, you are going to pull your credit reports and scores yourself. Ron knows it. Me and Ron talk about it. And in fact, any of his customers that he gets that are iffy, he'll tell them to pull it before he does.
Yes.
Because the truth is, we don't want you going out there and saying, oh, I just want to see where I'm at if you know you're in the 500 ranges.
That's right.
Let's not see where we're at. Let's make sure that we're making our credit work for us. And what that means is, I know that when I go to him, this is my score, this is what I'm looking at, and so now I'm ready to apply. Inquiries stay in your report for 25 months so we don't waste them, right? And during the course of a mortgage, how many times do they pull your credit?
I'm only going to pull it once. There are going to be soft inquiries throughout the process, though. Those soft inquiries are to determine and to ensure that during that process, you didn't go down to the BMW place and sign for a $500 payment, which could throw your debt ratio out of the window. Or you didn't go down to Rooms To Go and buy a whole room full of furniture or rooms full of furniture. And believe me, being a mortgage loan advisor as long as I've been, that has happened. It has happened. Even to customers that we told that signed the form that says, do not do these things. Because part of the checklist that I provide to my customers is one that says, we won't do these things while we're applying for a mortgage. But people get tempted. They get excited. I'm closing next week. Let me go on over here and get this 60-inch TV. Do not
On credit.
On credit. Don't do it.
So,
just wait.
General rule of thumb, based on what he just said, is if you are past the pre-qualification and you've already started in, what's it called? When you're closing? Well, you don't.
Yes,
you're not
you're
necessarily
in underwriting.
closing.
You're in underwriting.
underwriting. Thank you for using the proper term. don't buy anything using credit. Don't change anything. This isn't the time where we all of a sudden put an extra $10,000 in our bank account. It's not
Correct.
the time where we pay off those 2 cars or
We go loan our cousin $5,000 because they're going to grad school and they promise to pay you back. We don't do those
we
things.
don't go get any more loans. We don't change bank accounts.
Probably not, because if you go and get a bank account, they're going to pull your credit.
What about if I want to go ahead and get cable?
Probably need to wait to get cable at your new residence.
I'm going to get a new cell phone company because I'm so tired of whatchamacallit.
No, I'm going to think you need to go ahead and keep T-Maybe until... I'm sorry, T-Mobile. I didn't mean that. You're going to keep T-Maybe until you close.
So you're going to keep T-Maybe until you close on that house?
Yes.
Now, what happens if I close on Tuesday? Now, can I go do it Tuesday after I close?
I would wait 24 to 48 hours after I close.
Okay.
That's not to say you couldn't, because actually once you've signed the actual mortgage note, the house is yours and you're actually closed, I still would wait, because post-closing, there are still things that have to be done with a mortgage after you close. So I'm a proponent of being cautious. That's just my way, except when I'm fishing. But being cautious just means you're not going to do anything that could jeopardize this transaction until it's complete. You done start move boxes in there. You in the house. You done put the welcome mat out front. It's home sweet home. You done made your first pot of coffee in it. Yeah, it's your house then. But in the meantime, let's try to be vigilant and protect ourselves by not taking any unnecessary risk. Because an unnecessary risk could mean Murphy's Law will get us every time. We don't like Murphy's Law.
Okay, so a couple of quick questions about some things, and I got some messages popped up sent to me. So
Cool.
Yeah, I love it when my people talk back to me. Guys, if y'all have questions, just shoot a message in there, and we will answer them live, because we really are like really live. So what was I saying? So that being said, my question is, because you got some too.
Yeah, I was just taking a look. Please feel free to inbox me, Ronald David Rice. And if you're friends with Millie, in all likelihood, you're probably friends. You can see my stuff. I don't think I have it set up where a non-friend can't see my stuff. But
you can't. You're gonna have to search. I have my friends private.
Oh, okay.
I protect y'all. Y'all babies,
nice.
I protect y'all.
Nice.
But he's
I'm
Ron
open.
David Rice. And,
It's Ronald David Rice. Ronald David Rice.
Can you apply for a pre-approved card to improve your? Are you talking about a secure credit card? Because I know you know better than secure credit cards.
She didn't mean that.
Now, if you mean pre-approved, that sounds like that, but you're not going to apply for anything while you're trying to get a mortgage, because we don't want to do that.
Let me get it. You don't want to apply for any credit, even if you're trying to improve your score, because in all likelihood, the score that you have at that time is going to be one that I've used to qualify you for. So during the mortgage process, you're not going to do anything to try to improve your score. You're going to make your payments on time, yes, but you're not going to go do something like try to improve your score by getting a new card or lowering your balance or something like that. Just continue. Authorized users. Let's not do any of those things, because what happens is if you add an authorized user, you become responsible for the half of that payment. I had a borrower who couldn't qualify for a mortgage because she was a qualified user on an American Express card that was one of those pay every month cards, and the lady would run it up, her aunt would run it up to like $10,000-$20,000 every single month. Well, guess what? She was responsible for half of that payment every single month. So I had to have her remove herself from being an authorized user, so that she wouldn't be responsible for half of that debt. And as a result, it helped her qualify, and we were able to move forward.
Okay, so really quick question, because we keep getting this. I need you to explain the difference to me between balances and debt I owe and debt to income ratio.
Okay. Balances are going to be your credit balances, how much you owe versus how much your credit line is. So if you got $1,000 $1,000 credit line and you owe $700 on it. Your debt to income ratio is going to be the percentage of that payment that factors against the income that you have. So if you got $3,000 in debt and you have $5,000 in income, we can simply invert those and divide one into the other. That doesn't give you an accurate depiction, because there are a few other things that are figured into that algorithm in the underwriting software that I use. But in short, you've got $3,000 worth of debt against $5,000 worth of income. You're already more than half, more than 50% of what you owe. So that's a quick way to kind of check yourself. So if you owe $3,000 and you only make $5,000 every single month, and then you want $1,000 mortgage payment, that's probably not a math that's going to work out well for you. In fact, you're already over 50% of what you owe at that time, which means you're rapidly approaching, because this credit that you have is accruing interest. That interest means your balances are growing, which means your payments are growing. You're not getting out of debt. You're actually getting in deeper debt. And that's probably not a good, as Millie often preached, and I did when I was here at Credit One, we want you to lower your debt. Do the things that can lower your debt. Be the one, be in control of your ship. Otherwise, you're just one mischeck or one layoff from getting
flat tire is what I always say.
Flat tire. You're one flat tire away from missing a payment and then subsequently affecting your credit score that it may take 6, 8, 12, 16 months to rebound from. And we don't want to do that. We don't.
Now, that being said, there's a question that I get. People want to buy a house, but they had a recent late payment on a credit card, 30-day late payment on a credit card, $25 credit card.
Okay. That is not going to disqualify you. It's going to affect your score adversely, but it's not going to disqualify you. Oftentimes, a letter of explanation can be a thing that can help you explain what happened on that. It was an oversight. I had a customer who had perfect credit, but he had one late payment. And what happened was he was staying in a hotel doing business, and he hit submit on his payment, and for some reason the Wi-Fi or something was out, and it didn't submit the payment. Midnight hit, and that payment was a 30-day late. Well, he subsequently made the payment the next day, but he had that one late payment. He, of course, could explain that with a letter of explanation, but it actually adversely affected his credit score. And the creditor, believe it or not, with his perfect credit, wouldn't give him a break on that. They counted him that 30-day late because he actually was late. So I can say to you, a mortgage late, not a mortgage late, but a late on a credit card is not going to disqualify you, but it's something that you'll have to explain. You want to explain. A letter of explanation is what occurred, why it's likely not to happen again. So keep that in mind. Anything, if you got credit that's tattered, you got bad stuff on it, and you want to get pre-qualified because your score is a 640 and stuff, but you got a bunch of stuff, just know everything you have on there, you're going to have to explain with why it happened, why it's not going to occur again. What did you do to fix that? So if you those two things equal a letter of explanation. So that's good information.
Don't get pre-approved until you're really ready to aggressively search and buy, because it takes a hit on your credit and only lasts up to 3 months until you have pre-qualify again. Another hit. Is that true or false?
That's absolutely false. What they told you is false. And I'm sorry, I'm not trying to speak against somebody who may have been trying to give you good advice. He may have even been trying to help you. But anytime you have a hard credit inquiry, it stays on your credit for 25 months.
No, the pre-qualification. How long does that last?
Oh, the pre-qualification can last sometimes, I'd say 60 days. 60 days is going to, in about 45 days, you can have a true material change in circumstance. That means you were late on something right when you got pre-qualified, but it didn't report to another 30-day cycle. So that's typically about 45 days. In about 30 to 45 days, your credit will change, depending on a good or bad thing that you did.
So it is true that if you're looking to get pre-qualified, you need to be looking to buy.
I would say yes. I would say yes.
Okay.
When you get pre-qualified, here's the premise behind getting pre-qualified. Number one, you're wanting to know what you qualify for. If I tell you qualify for a $1,200 payment, what's to preclude you from moving forward right now? Why wouldn't you go ahead and move forward? Rates are low, all these things are in place. You got pre-qualified. And you say, nah, I think I'm going to chill. I want to wait for another 3 months. Well, if 3 months your credit score is 20 points lower, you may qualify for a higher interest rate than you would have at that time. Could be that at that time, though, you didn't have the down payment money. Let your mortgage professional guy work out some things for you. He might be able to help get you some grant money or some down payment assistance, something that would help bridge that gap to get you in there. I can tell you, if you're qualified, we mortgage loan advisors, we figure out a way to get you across the finish line. Okay. So I would say to you, if you get pre-qualified, the pre-qualification will last for that short period of time, but the credit inquiry, we know, stays on there for a longer period of time. And the next time you get pre-qualified, you're going to have to explain that previous credit inquiry. Any credit inquiries you've had, typically within sometimes 6 to 12 months, you're going to have to explain. So if you applied for a Best Buy card, we want to know, did you take out new credit with them? How much do you owe? How much is the payment? If it's not reporting on your credit bureau. If you got turned down, then you just got to explain. I tried to apply for a credit card with Best Buy. I didn't get approved.
Okay. Another really important question that I get all the time is the whole shopper's window question. I get people who have applied at one mortgage company, they didn't like whatever happened there, and so they went out to 2, 3, 4 different mortgage companies. Is that a good idea?
I would say no. You have a window where you can shop, and there are just people out there that like to do that. Once you know what your credit score is, that's something that you can articulate to a mortgage loan guy, and he will actually try to do his best to give you numbers based off of that. Just know that by law, I'm not supposed to, when you call me, I'm not supposed to say, you qualify for 5%. I'm supposed to give you an interest rate and an APR. That means the APR is based off the credit, off the closing cost scenario that I plugged into. So pre-qualification just isn't simply picking up the phone and calling me and saying you can get a 5% interest rate. It's more information that goes into that. Closing cost, down payment, final numbers. I actually have to put together an entire package to send to you, a loan estimate that I send to you within 3 days of when you apply, that tells you your fees, your interest rate, and your APR. All those things are supposed to be disclosed to you by the lender. So if you're talking to somebody, each of them are supposed to reach out to you. Now, most guys like me will withdraw your application, will, rather than turn you down and go through all the steps. Because if I get 100 calls a day of people that want to get pre-qualified, but only 20 of them want to buy, I'm not going to go through all of that other stuff on the turn down stuff. It's too much. But what I can say to you is that if you aren't shopping for a mortgage, you absolutely are well within your right to shop. But the first person that you talk to should be able to give you adequate information for you to do the other legwork. Don't call ABC Mortgage, 123 Mortgage, 456 Mortgage, 9, 10, 11 Mortgage, and get credit inquiries with all of them. You're shopping against yourself is what you're doing, because most everybody's interest rates are typically going to be somewhere between 1/8, 1/4% to 0.5%. So the savings, it's going to be negligible unless you're buying a $2 million house.
And even then, they're probably not shopping.
Right. When you can buy a $2 million house, you don't shop. You just go buy a $2 million house. So I agree there.
Yeah.
I want to jump back into some of my points because I wanted to talk a little bit about representation. If you are trying to buy a house, representation is something that you need. You need representation in the form of a mortgage loan advisor, but you also need a realtor. Realtors are paid by the seller. Let me say that again. Realtors are paid by the seller. They're not a cost to you. You don't have to sign a big contract with somebody, but if you meet a realtor that you like and you do want to retain their services, there is an agreement that you can make with that realtor. I'm not a realtor, so I don't want to go down the rabbit hole on that, but there are some great realtors out there. I work with lots of good ones, too many to name, so I don't want to name 2 and then all the other 100 are mad at me. But what I can tell you, shout out to my favorite realtor. You know who you are. What I can tell you is representation is going to be a good thing because they represent you. They're going to negotiate, number one, seller paid closing costs. They're going to negotiate things getting fixed on the house, throw this in. That's what a realtor's job is, to make that process go smooth for you. They work hand in hand with me. They come to me, they bring you to me, and I give them the money so they can make you happy. So the realtor's job is to make you happy, but let them do their job, and they will do a great job for you. I don't encourage you, though. You can't go get a realtor without seeing me. You need to be pre-approved. The realtors in our market right now are hopping because our market is wide open. So don't bug them calling them saying you want to buy a house if you haven't been pre-approved. You want to be pre-approved. Most of them won't talk to you unless you're pre-approved. So you want to go through those steps of getting pre-approved. And
why
then,
won't they talk to you if you're not pre-approved?
Because you can't buy. We have limited. I'm speaking realtor talk now. Realtors, forgive me if I mess up, but I'm just going to say this. Our market right now, I'm not saying it's saturated. We have thousands of jobs coming into this market, and people are all over the inventory that's in place. So tire kickers, they got tire kickers, and then they've got people that want to drive. They're dealing with the drivers. The tire kickers, they're going to let you kick tires until you're ready to drive. When you're ready to drive, call them. And I'm just doing that as a favor to my realtors, because what I don't want you to do after this is to get inundated with people calling saying represent me and they haven't gotten pre-approved. Come and get pre-approved first.
Okay, so let me tell you from the realtor side what they say to me all the time, because I work with a bunch of realtors who actually refer people to me. they don't want you to look at your dream house that you love, and this house is beautiful, and this house is $192,000 a year, is $192,000, and they're all ready to make an offer, and you only qualify for $160,000. Because unless you have $30,000 cash, which you probably don't, you're not going to be able to get it. And we want you to be able to get what you want. So they want to show you houses that you can afford. And the way they do that is by knowing what you are pre-approved for. Back to the mortgage guy. So he tells you what you can shop with. He gives you the money. They go take you shopping. They find what you want. He goes back to them. They finish it all up. They send it over to underwriting. And we try to get you a house in like days.
Yes. And part of the pre-approval process, know that the application is simply part of it. You can put on an application that you've been working at Raytheon for the past 5 years, but unless you can provide me with pay stubs and tax returns and all of the documentation necessary, your pre-approval is kind of in a holding pattern. That means it looks good, but I don't have anything to go with. It's like, dating. That guy told you he got a great job and I got a big house on the hill, but you ain't never been to his house yet. For all you know, he still live with his mama. You got to find out if he's got that big job and the house on the hill.
So you got to go to his house?
I'm saying you got to go to his house, but you got to do some research, more information. You need more information to make a good decision as to whether you need to accept the next date.
Very good. Very good.
So we were talking about realtors. I want to touch on something that's kind of in the same vein, not with realtors, rent to own. Let's talk about rent to own for a few minutes.
What's rent to own? Is that like land contract?
That's like land contract. But there are people out there, there's somebody on this thread right now that's renting a house that they say they're buying. How do you know you're buying it? What do you want to question?
Because they told me, I put like $10,000 down, and they told me that that goes towards the price of the house.
Yeah. How do you know you're buying it, though?
Because I signed a lease. Well,
You signed a lease. You signed a lease. A lease is not a lease is a binding contract to pay them a monthly payment on this property to occupy the dwelling for a period of time. A mortgage means I'm paying for this monthly in order to receive the deed that will be mine at the end of the terms we agreed. Two different things. I'm not telling you that you can't rent to own. I'm not saying that at all. And for those of you out there that may want to rent to own, okay.
I am. I'm saying don't do that.
Yeah.
$750, we come with a higher standard. No, because the mortgage, even if they're legitimate and it's, your cousin,
totally
mom, whatever,
I totally agree.
The mortgage is in their name, and they're getting credit for your payments. And they're getting credit for your payments at tax time and everything else. So you're paying them, but you're not getting the benefits. And that's if they're on the up and up. So I'm going to go ahead and go over his head and say, no, we're not doing that. We're not doing lease purchase or rent to own.
I was going to get to that. Where we're going with this is what you don't want to do is sign up for that 12-month rent to own, and all you're doing is paying your rent. And at the end of the 12 months, you're not prepared to buy the house because your credit is still in the same place. You hadn't saved any money. You haven't prepared or done anything. You hadn't gone to a guy like me to try to get pre-qualified or someone else, and you've done none of those things. So as a result, 10 months down the road, because those 10 months fly by, 2 months, you're like, baby, we can ready to buy the house now. And then you go to try to get pre-qualified, and guess what? You can't get credit on a pack where Wrigley's gone. That's not a good way to do it. If you're wanting to buy a house, attempt to get qualified. That's the steps that you need to take, because either you can or you can't buy. There's no middle of the road. Now, if you already you've been paying rent to your grandmama because you're going to buy her house from her or whatnot, you need to talk to a mortgage professional and get pre-qualified to see exactly how much you can give grandmama for that house. Make those steps. Take the steps to find out what you can do before you make a commitment. Otherwise, you're just signing a piece of paper that you're going to be paying, and then 12 months from now when you can't buy, that guy who's trying to sell that house is going to sell it to somebody else. Don't get caught in that situation. And then you're calling Millie wanting her to get your credit together in 30 or 45 days, and it can't happen that way. It's only happened to us 100 times. Times 100. Times 100. A year. And this week, somebody will call here and say, I need to get this house, man. We got to move in 30 days.
That's
Guess
true.
What?
And here's the other part with that. The worst part about all of that is they do this. There are actual owners out there who do this, and then they take your $10,000 or their $5,000 and they sell it, and they do it and they turn around and they rent to somebody else because they knew that you weren't going to be able to qualify. They were gambling and betting that you weren't going to be able to get this house. And so I made money off of you. I'm going to go ahead and evict you. I'm going to get somebody else in there. I'm going to give them the same rent option deal. And now I've sold this $50,000, $75,000 house 6 times over in the last 6 years because I've had 6 people in here for a year, $10,000 down each, plus you're paying your monthly payment every month. So I'm just making money hand over fist. And now I own the house that, thanks to your mortgage payment, I own the house that you wanted to buy.
There are actually landlords. There are actually landlords that do that. They know that you can't buy. They'll take your money and have you do exactly what Millie said. Don't get caught up in that. Let's come up with a plan, because if you have a plan, come up with a plan that's, number one, attainable and measurable. That means you know what you're I'm saving this amount of money every single month with the goal of achieving this. I'm going to put this money down at the end of these 12 months. I'm going to get my credit together. I'm going to try to get it pre-qualified. There are mechanisms out there, information that's available. There's no reason why you should be on Facebook more than you've been on your bank account or on Credit Karma or on any of the sites, Experian or any of those that can provide you with information that can get you to where you're trying to go. Don't ask so many questions. Do some of the research.
Really quickly, when you're saying have a plan, and if my plan is I want to move into a house, my lease is up in December of next year. When should I be pre-qualified?
Good question. That's a good question. When should you be pre-qualified? You have 12 months left on your lease. One of the first things I would do is I would look at my lease and read it in its entirety to see if there are any clauses available that I might be able to escape this lease. If there's something that could get you out of that lease without you having to pay the full balance or having a blemish on your credit or something, I would move to the next step of finding a mortgage professional and see about get pre-qualified.
Okay.
Now,
my credit score is a 510, so I know I'm not ready to buy yet. Do I have 12 months to get my credit together before I start looking?
You have 12 months.
Or do I have less time than that because in 12 months I got to be out?
Well, less time might determine on how quickly you work your magic. I've seen you do some stuff. I've seen you do some
that's
stuff.
True. No,
I'm not talking about the credit.
This month. We're not talking about well, listen, I work magic in folks' lives all the time. That's what I do over here.
Okay.
However, let's just say this is a situation in which magic isn't necessary, just a little bit of time. How soon should I start looking if I need to be out my house? 30 days, 60 days, 90 days? Or can I just wait till December? I'm going to go get pre-qualified on the 1st and be out by the 31st.
Well, what you don't want to do is go and try to get pre-qualified and you're 12 months away. You wasted a credit inquiry, because what's happened is I pulled your credit. I can see that, number one, you don't qualify. And then number two, we've got an inquiry that's going to be on there for 25 months for nothing. Because right at that point, you're in a lease, you can't get out of the lease, and you're not ready to move forward. What you would do during that 12 months is embark on a credit repair journey to get your credit together, come up with a financial plan to save a certain amount of money, and then more importantly, be vigilant in your job, keep your work history together by staying at your job and being stable. Don't bounce checks, don't miss payments, don't lend money to people, don't co-sign with anyone. Stay on the path. Don't be tempted to go get your Louis bag or your fancy car, because the credit clinic down there says they can get you in a house if you make $350 a week. I said house, I mean car. They said they can get you in a car for $350 a week unless you're walking. And depending on how far you're walking, I say to thee, nay, don't do it. Stay on the path to try to get to home ownership, because home ownership creates a legacy in you and in your family that can't be taken away unless you don't pay. But create that legacy by stepping into home ownership, and it's available to you. We're in a market right now where they are doing things they weren't doing 3 years ago. I'm here to tell you it's available to you. Let's get back to some bullet points. I was talking about pre-qualify, but don't do it for the fun of it, i.e. you got 12 months. Don't do it for that. Have a plan, 1 to 5 year plan. And then if you need credit repair or some help with your finances, there are resources that are available. Companies like this one that can help you, Credit One USA, help you get on the path to, number one, having an excellent credit score. Shout out to 750 Score Challenge.
Hey! We like it.
You can
We want it.
you can have that score. Whatever you want is attainable, but you have to put a plan in motion. And it starts with number one, knowing what your buying power is, being able to save money, taking care of the business, keeping your word. Your promise is the most important thing. Because guess what? The bank doesn't trust you because they don't know you. But when they see your promise, how you've kept promises with other people,
Your trust report.
yes, they're inclined to take a chance if you kept your promises. If you haven't kept their promises, it's going to take more than just a few different things to get them to say yes. Down payment, stable job, all of the things that we talked about earlier in this podcast. Now, I see we got a lot of people tuning in, but I don't see a lot of questions. Come on, you can ask questions. Get questions answered. I can answer some questions about that. Or feel free to inbox me. I see somebody on this podcast. I ain't going to call you out, but I'm going to say you hadn't texted me recently. My guy. You know who you are. My man.
I know who
I love you, man. Holla at your boy. We need to get caught up.
Tell him we're going to get a house. You're going to get a house too. I see a couple of y'all on here who going to get a house. Us a couple of y'all who going to get houses, not
yes.
house.
And I'm going to go over a quick list. I didn't go over how many states I'm licensed in, but I do have to go over that. Go ahead, Millie, while I'm pulling that up. I should have had that already.
Okay, so a couple of y'all have inboxed me and sent me messages and stuff like that. So I'm going to just jump in and answer some of these questions. So he talked earlier about what score do you need to get a house. Honestly, the minimum threshold is...
I'd like to say 580.
However, we don't want 580s because, of course, this is a 750 home right here. And we know that with 580s, you're going to be paying way, way, way too much. You've been pre-approved. Your lease is up with 6 months. Is that adequate time to buy? Absolutely.
Yes.
Absolutely. And you might be able to look in your lease and they may have an option where you can get out of it early if you're purchasing a home.
And I didn't mention that there are some that have clauses in there that if you are purchasing your first home or a home, they will allow you to, jettison the lease so that you can move forward and acquiesce your dreams without furthering acquiescing theirs.
Yes. I'm sorry, guys. I was looking out the window because it is snowing in Huntsville, Alabama. I don't know if y'all like that. Do you help people repair their credit score in Georgia? Yes. Credit One USA helps people all around the country. This is what we do. We love it. We have a wonderful system set up where you don't have to be right here for us to help you, and you get the same kind of help, just a little bit over the phone. But if you want to come see me, I like that part too. I love talking with y'all. So, of course, that's my thing. And what I'll do, Miss Nancy, is I will send you the link so you can do that. How much do college loans and a positive status affect your credit score, or has that been asked?
That's a good question. Let me address that.
Hold on. One quick question, because Miss Nancy came in late and she missed it. Leasing to buy is the same as renting to own, and no, it's not a good idea. No, never, no. Reason we say that is because it's not always guaranteed, and it's usually in favor of the owner. They normally put like a 12 to 24 month time frame on that, in which case at the end of that period of time you wind up losing your deposit. So we don't really like that part. So Miss Nancy, no, we're not going to do that. But if we need to improve your credit so that you can get one, I can get you all set up for that. Now, going back to Miss Lovey's question about how do college loans in positive status impact your credit. And we're going to have to get into Cavers too.
Fantastic. Yes. Your student loans actually do affect your debt to income ratio because the aggregate amount of the loans that you owe, a percentage of that is factored into the payment, even if they're deferred. FHA requires that you count in a percentage of the aggregate amount into your debt ratio. So if you got $150,000 in student loans, that payment, depending on your income, could affect your score. It could not affect your score, but they have to definitely be in a positive status, and that's for government loans. Conventional loans will also want them to be in a positive status. In your question, you ask if they were you ask about positive, so I'm assuming they're in a positive status. They do affect you on a government loan. They actually aren't counted on a conventional loan, so that would be an opportunity to consider conventional over a government loan because student loans aren't to be factored in. The aggregate amount. A percentage of the aggregate amount is factored in on government loans, but not on conventional.
Let me ask a quick question there. What if you're on an income-based repayment option and your payments are zero?
The aggregate amount is still going to be counted.
The aggregate amount is still going to be counted as a percentage?
As a percentage of the aggregate amount.
Okay, so is it better to be on something where it's lower on a zero or to be deferred?
Does not matter. It does not matter because it doesn't, if you're on a zero, deferred, whichever, I'm going to take your student loan balance, if it's $50,000, and take a percentage of that to create a payment that counts against your debt ratio. Okay. That's in government loans. Now, on a conventional loan, it's not going to count. And on a USDA loan, the percentage is lower. So if you're going to do a USDA, the aggregate amount is a lower amount than it is on FHA.
Okay. Now, I'm so glad somebody brought up student loans because I had a question about those. So, I have customers from time to time who are out of school for a longer period of time. Let's just say 12, 15 years. And their student loans don't report anymore. Not because they paid them off, but because, that statute of limitations that say 7 years of reporting, and then it doesn't report anymore. So now they want to go get a mortgage. How's that going to work out for them?
Okay. If it's not reporting on the credit, first let me give you the ethical. Let's be ethical first. The ethics part of that is that if they disclose to me that they have student loans, then I have to count it. I can't not hear that. I have to count it. Because if I don't count it and then it's discovered later down the process, we signed a mortgage application that's fraudulent. And I don't know about you guys, but an 8x10 sale and,
I'm
fraud, felony and all of that, that's bad for my complexion. I'm sorry. That doesn't work out for me. So if you disclose to me that you have student loans, we have to count that aggregate amount to determine how it affects your debt ratio. Now, if it's not reporting on your credit, and we're both pleasantly surprised that we didn't know, you signed the credit application and but I signed it and I didn't know, if it doesn't ever come up, guess what? It doesn't ever come up. But if it does come up and you did not disclose that you have debt that was not disclosed in the application, that is fraud. And the mortgage holder can actually call the loan due. That means they can say to you, you've only been in this house for 2 years, pay us the rest of the 28 months or vacate.
28 years, you mean?
Yeah, 28 years, I'm sorry.
Which was 28 months.
Yes, so you don't want to do a fraudulent application because the lien holder will actually call the note due.
Okay, so I've also heard about this system called Kavers.
Kavers.
Tell me about what Kavers is.
Kavers, you are provided a Kavers number anytime you have a government loan. So the Kavers system actually tracks your activity in government loans. So any government loan that you might have, FHA, VA, any of those, Kavers you're gonna have.
What about student loans?
Student loans as well.
So if I default on my government-based student loans, and it's been more than 7 years, can Kavers catch me?
Yes.
And what happens then when I'm trying to complete this FHA loan?
You're just not going to get that loan because you defaulted on. You can't get new government money if you haven't paid old government money.
That's what I needed you to say.
So
that part right there.
For those professional students out there with a lot of student debt, make sure you pay your government loans. Even if you have an income-based repayment program, pay them on time because they will affect your credit and your ability to obtain a mortgage and or a program that could get you in there like zero down, like USDA or something like that. You can't get that loan if you have not paid student loans.
So no new government money if you owe the government money, if
Correct.
You defaulted on the government money.
Correct.
Really quickly, guys, if y'all have defaulted, it's okay. It's not the end of the world. They actually, especially with public loans, government-based loans, they have programs called rehabilitation agreements, consolidations, and many, many, many options to get you back on track in as few as 3 months. So, y'all, if there's a problem, I got a solution. So, give us a call if you need this, if you have questions about this. If you have mortgage questions, we got about 2 minutes left. We've done a lot of talking. Covered a lot of tech.
And honestly, I looked down at the clock and I didn't believe 58 minutes have already passed. That means two things. I talk a lot. Because we've talked for almost an hour. I didn't realize, I thought we'd only been on about 15 or 20 minutes. But we've actually already been on an hour. But I encourage you to send some questions in. If not, feel free to inbox Millie or myself if you have a question or something that we didn't address today. If I talked about something and you have further questions, or if you want to get pre-qualified, she is going to put that link down there in the bio for you to be able.
Florida. Can you help me?
Yes.
Yes.
I'm licensed in Florida though.
So we both can help.
Yeah, we both can help.
So I don't know if you need
and I'm a
credit
Gators
repair
fan.
or if you need.
Stop hating.
M Go
Stop
Blue.
hating.
We have this
Stop hating.
discussion all the time. He actually likes some very bad company people. He likes, the Gators. He likes the Minnesota Vikings. We're praying for him, and eventually he's going to be delivered from them bad choices. However, in the meantime, going back to credit, because this is something that he does with the mortgages, he is licensed in 15 states, and he's going to give us that list before he gets out of here.
Actually, Millie's going to provide that list because I was just looking at this and it's not updated. My list is fluid. It's changing. I eventually will be licensed
said she's a... Oh... I was liking you, Miss Christina. I was really loving you. I'm sorry, y'all. If y'all don't know nothing about that,
I'm licensed in Ohio, though. Yeah.
I taught my children that word that he just said is a curse word, and they're teenagers, and they very rarely even use it even now. Now, he's licensed there, but master's degree. Okay, good job on that part.
Then the Columbus too liked it there. Had a ball, played golf, Silver Lakes
I'll
golf
drive
course.
around it.
Silver Lakes.
That's the school. That's not anything about this. But yes, we help with credit as well as we help with. Yeah, they are.
Oh, so for real? So we doing this? Number 2 in the nation.
Are you really gonna troll me on my own feed?
Yeah, just like that.
I feel so bad right now. Like that's okay. We're gonna get rid of Harbaugh, and eventually we're gonna come back, and we're gonna do what we've been doing.
That's right, y'all playing Alabama in y'all bowl game.
Yes, we are. That's gonna be a tight one because we got a lot of January the 1st.
Me and my guy, we got to talk about that. Wow, I can't believe it's 3:00 already.
It's actually after 3:00, guys.
But check this out.
Credit and student loans. Just send me a message. In fact, I will. You can direct message me, Christina, and we can talk about this some more. We would love to help you with your credit, with your student loans, and getting you into a house and all of that stuff. Congratulations on your master's degree. We know that requires dedication and commitment, and if you can dedicate and commit to that, we know you can commit to you, and your credit will show it. So, that being said, again, he's Ron the Mortgage Guy. I'm Millie the Credit Lady.
Next to me on Instagram, Ron the Mortgage Guy. You can find me on Instagram as well. So, and of course on Facebook, Ronald David Rice. I'm a loan officer with Hometown Lenders. NMLS number 65084. My NMLS number personally is 309793. I want to thank you guys for having me.
He is going to actually put his information in here as soon as this is over. He's just going to say, hey, it's me, Ron, with how you can get in touch with him. He'll put a phone number and all of that wonderful stuff. You guys know if you have questions, comments, or concerns, you can send me a message. You can give us a call at 855-273-3663, or you can visit us online at www.creditoneUSA.com. And of course, that's the number 1, not the word. It's been an awesome pleasure with you guys. Until next Tuesday, this was Talk to Me Tuesday with our special guest, Ronald David Rice, a.k.a. Ron the Mortgage Guy. Thank y'all for tuning in.